All right. Good evening, everyone, and welcome back to enter the Entrepreneurial Assistance Center at Suffolk County Community College. And tonight, we're going to talk a little bit about understanding funding and investment options or types. Okay. Before we proceed, I'd like to thank again Suffolk County Community College and the Entrepreneurial Assistance Center staff, Jennifer, Kenya, everyone involved in putting together these seminars or webinars so that you can gain additional knowledge as an entrepreneur and a small business owner. So I see we have maybe like 15 participants altogether, 11 attendees with panelists. So thank you for being here. I appreciate you. And I know that you could probably be doing something else with your time, but you've chosen to be here. And that is an amazing opportunity for you as a business owner. And I really look forward to, exchanging with you tonight during the presentation. If you have any questions, please feel free to type those on the board or the chat, and then the team at Suffolk County EAC will let me know, and then we can proceed. Okay, so thank you so much. So we're going to cover today, let me see if I can get this moving. We're going to cover a few things today. I want to do a review of your financial needs and how you need to evaluate those needs. The importance of creating a capital access campaign, making sure that you understand your credit worthiness and how that comes into play, and in terms of investments and financing. And then we're going to talk about, a deep dive into the sources of financing and investment. That's going to be followed by, I'm going to share perhaps some of the elements that you need to include when you create a pitch deck. And then I'm going to end this presentation with a list of investors in New York State that you can approach once you follow through all of the items and you've done all your checklist for investors and financial needs. Okay, so let's get started. So the first thing that you need to keep in mind as a business owner, when you are looking for financing, right, you have to evaluate what is that financial need that you have. Make sure that you know what are your current expenses. Analyze your expenses so that you can understand your financial position and determine what is the funding requirement. I mentioned this before in one of the previous sessions because it's really important that you come to the table when you're looking for financing or you're identifying investors for your business, having a very clear understanding of what is it that you need, because banks are not going to give you money for you to sit in, for the money to sit in your bank account. They want to give you money so that you can grow your business, right? So you have to understand what are those expenses, what are the uses of funds, etc. The other thing is that you want to be clear about, how this is going to impact the future growth of your company. So you want to understand the projected revenue, how that revenue is going to, over time, make your business grow, right? And you have to be able to understand the impact of that growth. And then you want to understand what are the funds necessary for that growth. In other words, so you have identified that you're doing a marketing campaign. That marketing campaign is going to maybe create an opportunity for you to enter into a new market, which is going to generate perhaps $100,000, right? So what is it that you need in terms of a loan or an investor to be able to reach that $100,000, okay? And so it's always good to understand clearly what is that need that you have. If you need only 50,000, don't ask for 75. If you only need for 20, don't ask for 50. Always understand your need and how that investment that you're bringing into the business, whether it is through loan financing or whether it's through another alternative like crowdfunding or an investor equity financing, how that's going to impact your overall business. Okay, so know your expenses, know your revenue, and understand the impact of your company's growth, how those things are going to help you grow. You want to have a very clear, okay, a very clear capital access campaign. And you want to create a business plan. So you want to have a well-defined business model that revenue. This is something that we've talked before in some of the previous sessions, because your business plan serves as the foundation for your business, right? You can't say, well, I know what I'm doing. It's all in my head, right? Lenders, investors, they want to see that what it's in your head, they want to read it. They want to see it on paper, because they also want to make sure that they understand that they want to feel confidence, right? That you understand the business that you're in. Okay, and creating that business plan and that access to capital helps build confidence, from investors and bankers, lenders, to be able to give you money. You want to understand your market, right? You can't say, well, my market is women. Well, which women, right? Where are they located? Are they married women? Are they moms? Are they seniors? Are they retirees, right? Who are the women? You want to be able to do a very thorough analysis of your market, identify your audience, who are your competitors, and understand what are those market trends. What are the things happening in the industry as well as in the marketplace and with people and with consumers, right? That is leaning them whether to buy more or save money, right? Because depending on the season, depending on the economic times, people may feel more, open to spending and buying things and going on vacation and just splurging in general. But then there are times of recession where people just feel like, you know what, I better hold on to my money, right? That's a smart thing to do. So you want to understand that. And one of the reasons why it's important to do your market analysis is because you'll be able to get a pulse of the market, the industry, the consumer trends, etc. You want to be able to create realistic financial projections. I believe the last class that we had, we talked about creating your budgets, your marketing budget, your personnel budget, your operational budget, and really having a very good understanding of what is your break-even point. In other words, how many units do you need to sell of X product or service so that you're able to cover all of your expenses? So your financial projections provide an estimate of future revenues, expenses, and your company's profitability. And they are really important to investors and lenders. So you want to be able to have a very clear understanding of your income, of your expenses, of what profit you're going to make, how many units you need to sell, etc. The other thing is, in this capital access business plan, you want to have an investor communication strategy, right? Because the business plan helps you communicate that vision, right, to potential lenders, to potential investors, and it builds confidence in terms of what is it that you are presenting, that idea, that product, that new invention that you have, okay? So the business plan is going to serve as that key communication tool for investors and lenders. Very, very important is to understand your credit worthiness, because your credit worthiness is crucial, very important for you to secure the financing you need from lenders. And it influences, your credit worthiness influences how lenders and investors feel about you and your business, okay? So everybody in the United States, like everybody, like I would say like most 90, I don't know, 95, I'm gonna make up a figure, like 95% of the people have credit issues. That's not that's not a deterrent for you to get access to credit or even an investor. The most important thing is look at your credit, right? Because when you're starting a business or when you're launching the business, let's say you've been in business only 2 years or a year, let's say under 3 years, you've been in business under 3 years. Lenders and investors are going to look at how you manage your own money. They're going to look at your credit report. They're going to look at, are you overspending? Lenders want to see even your bank statements, your personal bank statement, and they'll see like every time that you go to a Starbucks and spend, $7 for that macchiato, right? And they'll see a pattern, right? A behavior that helps them understand what kind of a person you are, right, with your finances. And so be mindful of that, right? Be mindful that during those initial 3 years of you being in business, you and the business are one and the same. In other words, lenders are going to look up to you to determine whether they're going to lend money or they're going to invest money in your business. So if they don't feel comfortable because they see that you're the type of person that you waste money, that you are constantly getting into debt, that you're late on your payments, that's going to, create lots of red flag, and they're not going to have confidence in what you're doing. Why? Because the biggest relationship, I think the second, Joyce Moy, who's a consultant in New York City, she's a financial consultant. She said it best at one of the conferences I attended with her. She said the second most important relationship that you have in your life is with money. The first one is with your faith or your creator and your family, right? That's the first one. But the second most important relationship that you have in your life is money, because money makes the world go around. You need money for everything. We don't work in a bartering system, right? We work in a capitalist system. And therefore, your ability to handle money, your ability to manage money, to keep money, to save money is looked upon when lenders and investors are looking at you, at your business. And so I was saying that there's a high percentage, over 95% of people in the United States have issues with credit. That's not a new thing, right? What is important is that you actually check your credit score, make sure that you address those blemishes, that you make payment arrangements, that you actually are on top of your finances. That's really important. What are the issues that you have in your credit report? Talk to the lenders. Oftentimes, people avoid speaking with the creditors. They see the number, they know it's Citi or whatever credit card that you have, Macy's, whatever, right? And then they know I haven't made my payment in 30 days. They're probably calling because they want their money. Yeah, they want their money, but avoiding the phone call doesn't make them go away. You're avoiding them temporarily. They'll call again, they'll send letters, and then you'll feel harassed. So it's always important to deal with the elephant in the room. You have a credit situation, a credit issue, deal with it. Don't hide, don't try to escape. It's not going to go away, trust me. So make sure that you deal with it. And then also understand how lenders evaluate your credit. And that's usually a conversation that you could have. For example, a lot of CDFIs are community banking institutions. CDFI stands for Community Development Financial Institutions, CDFI. So these community banks, what they do is they lend money to small businesses. One of them is in Long Island. It's called La Fuerza CDC, La Fuerza Community Development Corporation. And, we've had through this program, the EAC program, referrals to that particular CDFI for entrepreneurs and business owners who are looking to get a micro loan or a small business loan. I think they lend up to $50,000. One of the good things about that particular lender, La Fuerza, is that they're not going to base their decision solely on your credit worthiness. They're going to look at your credit, and they're going to want to hear an explanation if there are blemishes. If you've been late, they're going to want to hear what have you done about it. But they're not going to make their final decision just based on credit, because they're looking at what? They're looking at the overall person. They're looking at your experience, your capacity, your ability to understand how the business moves. If you understand your customers, they're looking at all of these things and then they'll make a decision based on that conversation and that evaluation that they make of your business and you. So it is important to understand who you're approaching in terms of you understanding how the lender evaluates your application. Okay, so get to know the lender, talk to the lenders, let them know what your issue. Don't try to hide. Don't try to put things away. They're not going to go away. Deal with it. And understand that some lenders, they really want to make sure that you as a small business, as a minority, as a woman-owned business, that you have access to capital and that you have a chance to succeed. Because many times, bad credit is not always your fault. Sometimes a divorce can cause bad credit, a life circumstance, a sickness, COVID, a lot of people became unemployed. It's just a number of things that could happen in your life, right? In our lives, period, that could actually have an impact on our credit. And instead of hiding from that, deal with it. Call the creditors, make sure that you make payment arrangements, make sure that you ask for credit forgiveness if it's available, make sure that you ask for the interest rate to be reduced. Maybe they'll freeze the account so you don't have to use it anymore and you won't be tempted to use it anymore. But by freezing the account, you get a lower interest payment, an interest rate on your credit card, on your debt, and you get back into that track of paying. When you meet with the lender for a loan for your business, you can explain to that lender, listen, I was late. I had this issue, but I tackled it. I dealt with it. I have a payment arrangement, and that's going to help your lender understand your situation and be able to have a positive evaluation. Okay? So don't forget about this. This is really, really important. So let's talk about sources of financing and investment. So obviously, we're all familiar with traditional banks and credit unions. They provide loan products, tailored for businesses, right? They do have credit requirements for loans. Usually, traditional banks want strong credit history, right? They also want a detailed business plan, and it's the name of the game for traditional banks. You have to have either 680 credit score or 720 credit score before they consider you. That's traditional banks. Credit unions are a little bit more flexible, right? Especially if you're a member of the credit union and you've been banking with them for a while. They will look at your credit scores, but they're a little bit more flexible than traditional banks. And of course, CDFIs are the most flexible. One thing that you should know is that the government doesn't lend money, okay? And this is a misconception. The government doesn't need to lend money. The government has an agency called the SBA, the Small Business Administration. And what the SBA does is that they guarantee, right? They guarantee that you, as a small business owner, are going to pay your loan. So in the case where, let's say you go to Chase or Bank of America or Wells Fargo, one of these big banks, right? And you don't meet all the criteria for whatever reason, you can always ask, are you an SBA guaranteed lender? If they are, which most of them are, if they are, then they can put your loan application through the SBA program and get you a conditional guaranteed on your loan, okay? That's what the government does with the SBA program. And usually this guarantee secures up to 85% of the loan amount to the lender. So let's say that I go to Chase, I apply for a $100,000 loan. I don't meet all the criteria, but I get put into the SBA loan process. The SBA let's say that the SBA approves my application, they will guarantee to Chase up to $85,000 of that $100,000 loan. So now Chase feels a little bit better about lending that money, because if I default, then Chase is going to take that guarantee and is going to take back to the SBA and is going to say, Santos didn't pay his money. You gave me a guarantee of 85% of his money. I want to use this guarantee. And then the government basically will pay Chase, right? And then the balance of that money, you either have to come up with an agreement with the bank, and you definitely will have to make an agreement with the SBA about repayment, okay? So, but at least it takes the bank off your backs. Now you have to deal with the SBA. So there are many ways to skin the cat when it comes to accessing loans, but know that the federal government do not provide loans. They do not provide money. They do provide the guarantee. Now, there are also some grants that the government provides. And usually, grants are not a lot, and that they're not often, they don't happen all the time. But when they do happen, grants are money that you don't have to pay back, obviously, because it's a grant, it's an award. For the most part, government gives grants to nonprofit organizations, but it's not unheard of that the government does provide or can provide some grants for small businesses. But when they do, there's a lot of competition and there's a lot of criteria that you have to meet, okay? And so, and even forgiveness, right? So for those of you that went through COVID and had to file for PPP, and your loan was forgiven, that's considered a government grant because it was forgiven to your business and to you, okay? So there's two things that the government can do. They can provide a grant or forgive a debt, or they can also guarantee the loan that you're getting from Chase, Wells Fargo, wherever it is, okay? The bank on Long Island is La Fuerza CDC, which is Community Development Corporation, and they're a CDFI, which means Community Development Financial Institution. Okay, so I just put it on the chat for institution. Okay, for Terry. All right. I think someone raised their hand. Alexis? No question? Okay. Let's move on then. There are alternative financing options. Okay, I think someone else raised their hand. Pat? I'm not sure if they're able, I'm not sure if they're able to speak when they raise their hand. So, who is monitoring the chat?
You can speak.
Kenny, go ahead. Okay. I see
The raised
some
hand was an accident.
Okay. All right. It was an accident. Okay. Okay, let's talk about alternative financing. So we discuss loans, right? With lenders, but there's also like peer-to-peer lending, which connects borrowers directly with individual lenders, right? And this could be, you know, other entrepreneurs, other people that come together, you know, to lend each other money. There's crowdfunding, which is basically a type of fundraising for your small business in exchange for maybe some recognition. Sometimes when people do crowdfunding, they offer, like you'll be among the first, I don't know, 100 to get something, to get a gift card, or, we'll give you 20% off if you use it when we open the store, whatever. They usually they give you something in exchange for you to give money to the crowdfunding, whatever program or strategy they're using for their business. So it allows businesses to raise small amounts of money from many people, often through an online platform for their projects and ventures. And this is actually very popular. It's really a good source of raising money, but you have to have a compelling story. That's really important. You have to have a compelling story. You have to be able to, do a really good pitch about what you're offering in terms of your business. You have to be able to say, what are the things that you're doing, and have a really good strategy in place for crowdfunding. I think we talked about this during the first session. And then, of course, the other type of alternative financing is microloans. And microloans, they're usually small loans that are provided either by nonprofit organizations or CDFIs, and they usually are local groups. And a microloan could be, anywhere between like $500 to $25,000. So that could be considered a microloan. Where I work here, I'm in Tampa, Florida. Where I work, we do microloans up to $10,000 for the businesses in our area. So we don't do bigger than that because we don't have the bandwidth in terms of financing. So each organization, each nonprofit or each CDFI works differently, and they may actually, some CDFIs can do 50,000, even 100,000, and some CDFIs, if they don't do more than 100,000, then they'll partner with another lender to give you the money that you need. So they'll match up to their criteria, and then they'll bring someone else, another lender, to do the rest of the money, or they're splitting. Okay, but microloans is a great option. It's a great option to start small, have some level of accountability. They're very flexible in terms of terms and payments and credit, and and credit worthiness. And it really helps build small businesses. So if you have an opportunity to get a microloan versus a bigger loan, start with the microloan. That'll help you sort of like get off your feet and get going. And then once your business starts making more money, then you can apply for a bigger loan. Okay. And that also helps you build credibility, because if let's say you get a $10,000 microloan, and it may not seem like a lot of money, but $10,000 can take a business from $0 to $100,000. Right? Depending on the strategy that they employ. But that means that if you take a $10,000 microloan and you repay it in 2, 3, 4 years, whatever the term they give you, now you have built credit, not just for you as an individual, but you've also built credit for your business, which is really important. Okay. Let's talk a little bit about, and this is something, if you've been attending this series, today, by the way, is the 4th and last series. If you've been attending the previous one, this is familiar, because we talked about this in, I believe, the first and the last session. So equity investment refers to funding provided by investors in exchange for partial ownership or shares in a business. And there are 3 common, sources of equity investment. They are angel investors, venture capitalists, and private equity firms. Usually, when you approach an equity investment firm or individual, they're looking for high growth potential businesses, startups that have scalable models. In other words, you start here, but very soon you're going to be, in growth mode. And entrepreneurs who are open to partnerships and shared control. There are some pros and cons. For example, an equity investor can bring significant capital infusion, They also have expertise and networks. And usually with an equity investor, you don't have to repay right away. In other words, because the investors are going to take an ownership position in the company, they don't necessarily always want to get paid right away. They want to see how the business grow, and then after the business grow, boom, they take their money and they either leave and sell you back their portion of ownership, or they stay and then they continue to collect money. But usually there's no immediate repayment obligation. Now, one of the negative things or cons about investors is that you are going to lose partial control of the ownership of your company. So you no longer can make decisions on your own. They're going to be actively involved in all the decisions of the company. So if you decide that you want to hire or fire somebody, you have to run it with your other investors, right? With your other owners. If you're going to make a major purchase for the company, whether that's a vehicle or a big asset or an equipment, you have to run that by the other owners. So you no longer make decisions on your own. And usually the other con for this is investors, they're going to put a lot of pressure because they're in for the money, right? They're not in to stay there 20 years. They're in a few years, get my money and go. So those are the things that you need to be on the lookout. When you look at the different types of funding and financing options available, loans, you have to repay. Grants, you don't have to repay. Equity investment, you don't have to repay that, but you have to pay at the end, like their investment or whenever the percentage of ownership. But usually at the beginning, you don't have any repayment. And then crowdfunding, you don't have to repay either. It's a reward-based system. And then in terms of loan, you don't lose your equity. Your equity is yours. You don't lose control. You get a loan through Wells Fargo, Chase. They're not going to take ownership of your company. They're not going to take an equity position in your company. So you keep that whenever you do a loan or even a grant, right? And even crowdfunding. So crowdfunding, grants and loans, you don't lose any equity and you don't lose any control of the business. Equity investors, you do lose the equity and you do lose control of the business. Okay. So you want to look at all of the options and figure out, determine, should I go to a lender and ask for money, or should I approach an equity investor? Okay. Or should I do a crowdfunding campaign? A crowdfunding campaign, I can be very creative. I can create a compelling story. I can give people some rewards for investing in my business. And once I have the money that I set out to raise, then I can launch my business, right? So look at all the options before you make a decision. So let's look again at the three types of investors. You have angel investors, venture capitalists, and private equity firms. So angel investors basically are individuals who have money, and usually they invest their own money. They like to invest in early stage startups, very early, either it's an idea or at the seed stage, meaning that they want to be in from the very beginning. You meet someone, you tell them, I have this great idea for a cell phone charger. You don't have to carry your cord anywhere, and they like the ideas. How are you gonna do that? And then you start explaining how you do it, and then they get so interested, they say, you know what, I'm gonna help you build that business. So they come in at the very early stages of the startup. They usually are often the first outside capital that a business will have besides friends and family. And usually an angel investor can come in from $10,000 to $250,000. Sometimes they can go up to $1 million, but generally speaking, up to $250,000 is their investment. They may act as mentors to the company owners, or they decide to remain passive because they know that you have everything in place and they're only going to intervene when they have to. However, they usually expect a significant percentage of equity in the company because they're coming in at a very early stage. You don't have anything prepared. You're not in the market. So they'll come in and they'll say, okay, Santos, I'll give you $250,000 to help you create this product that people can buy and they don't have to, charge their phones with a cable. But I want 30% of your business. So those are the sort of like the things that you're going to get with an investor. Okay. An example would be like a retired tech executive who invests $50,000 in a food delivery app. Startup is in the idea stage with a prototype in development, and the investor receives 50% ownership and advises on the business model. So that's an example of what an angel investor could be in his or her involvement in your company. Let's look at venture capitalists. So venture capitalist firms are professional investors that are managing a pool of money. So they were able to get, 3, 4, 5, 6, 7 different individuals who have money, and maybe they are in themselves angel investors, and they are able to put in $200,000, $300,000 into this venture capital firm. And now the venture capital firm has X number of millions of dollars. And then they go out and invest in early to growth stage businesses that have a proven traction. In other words, these are not the early seed, startups. These are the businesses that they went beyond the startup phase and they're growing and they need funding in the amount of $1 to $20 million. They usually will become highly involved, not just with advice, but on the board and as part of the ownership. And they expect exponential growth and an exit. In other words, they're not going to stay with you forever. They gave you $5 million. They expect to make $20 million. And as soon as they make their $20 million, they're sign off and sayonara. You keep making the money. They made theirs already. Okay? An example would be a VC firm, venture capital firm, invests $5 million in a SaaS company. That's software as a service. So like an app, they invest $5 million in this app company that already has launched. They help recruit the executive team, and they help expand the business into new markets. They want 10 times more the return that they put in, and usually within 5 to 7 years, they'll leave after the acquisition. Okay, so they've been there for 5 to 7 years. They made 10 times their amount. They're going to get their money and they leave. Did somebody say something? I thought I heard something. No? Okay. And so then there's also private equity firms, and these are actually bigger. If you thought venture capitalist firms were big, private equity firms are even bigger because their investment can start at $10 million and go into billions. They can put the money forth to buy a large corporation, right? So you've heard of these companies that buy large corporations for $2 billion. Or there's an acquisition or a merger with one software company that was bought by a firm for like $700 million. So these are institutional investors that buy a majority stake in businesses that are mature. So we've seen 3 types. We've seen the angel investor that likes to come in at the very, very, very early, even before the company's launched, just the idea. Then you have the venture capital firms that want to invest in those businesses that already are running, right, and generating money. This type of firms, the private equity, they want to go into markets where businesses are already mature, seasoned. They have been around maybe 10, 20, 30 years, but now they need money. And the way that they're going to get the money is through a private equity firm, okay? They have deep operational involvement. Sometimes they even fire the entire executive team and bring in a new executive team. So an example of that, hold on. Yeah, sorry about that. I lost my presentation. Can you all still see it? Yes?
Yes,
No?
we see you. Yes.
Yes. Okay, great. Great, thank you. So an example will be a PE or private equity firm acquires a regional healthcare company. Private equity sees an opportunity with United Healthcare. They go, they make an acquisition offer of $5 billion. The management decides this is a great opportunity. Let's do it. The PE firm basically acquires the healthcare system, may implement new technology systems, may fire some of the staff, including some of the executive, and they will keep that company for about 4 years or so. And then usually they'll like to get 3 times their return. So if they buy it for $1 billion and that's what they invested, by the time they sell it, they're going to get $3-4 billion from it. Okay, so these are very large group. So let's look at a comparison. Angel investors, the sources of fund are personal. Venture capitalists, the sources of fund are pool of investors. And the private equity, the sources of funds are institutional capital. This is money that has been like old money, money that's been around, and it's from different sources, but it's a large amount of money. Angel investors, they like to invest in the idea stage, venture capital in growth stages, and private equity in large mature companies. Angel investors want to invest between $10,000 to $250,000 in their in those businesses. Venture capitalists can do $1 million to 20, and private equity firm can do 10 million and up to billions of dollars. In terms of ownership, the angel investor is going to take a minority ownership in that company. They're going to be an owner, but they're not going to make all the decision. In a venture capitalist firm, the investment is going to be significant in terms of ownership. And in a private equity firm, usually they have full control. They fire the entire executive team, they bring their own, or they keep some of their executive team, but they bring a new leader, etc. They have full control of what happens. Angel investors usually act as mentors. Their involvement can be, it varies. Can be, a lot at the beginning, later, not so much. Venture capitalists and private equity firms are highly, highly involved in those businesses that they acquire. And in terms of an exit strategy, in other words, now that I got my money, what do I do? So angel investors usually are looking for an IPO or an acquisition. The same thing with the venture capital firms and the private equity firms. They either resell that business or go into an IPO, okay, with the stock exchange. All right, so how do you choose the right fit? Well, look at, again, what of these types of investors are known for investing? Angels, startup phase, venture capitals, scaling phases, and private equity, established businesses that are mature. So you have to ask yourself, where is my business? Which stage? Am I a startup, a scaling up, or am I an established business? And then you can decide whether you're going to pursue one of these. So if you are approaching investors, make sure that you have a viable business. And what I mean by that You have to have a viable business, not some idea of a business, not something that you think it's going to make money, not something that is in your head and it hasn't been tested. You have to have a viable business. You have something that people need, that solves a problem, that solves a pain in the marketplace, right? Do you have a process to make that business a reality? Do you have a business plan? Do you have financial statements? So do your homework. Make sure that you work on that business plan, on those financial projections, on a pitch deck. Again, evaluate what is it that you have before you approach investors. And that has to do whether you're doing an equity investor, an angel capital, a venture capital firm, or you go to a lender or a CDFI. You always want to make sure that you have a viable business. You want to make sure that you do your homework, and you want to make sure that you work on your pitch. The last thing you want is to sit in front of an investor or a lender, and when they ask you, tell me what is your unique selling proposition? Why should people buy from you instead of others? And then you stay like, well, because my product is good. That's not good enough, right? You have to be able to define what is it that you're selling, what need you're solving in the marketplace, how you're going to do that. You have to create a model, a business model, and identify and describe how you're going to make money and why would people give you money, right? The interesting part, right? This is something I always say to in every type of entrepreneurial setting, teaching a class or a seminar. The interesting part is, this is the amazing part of being in business. You have something that people are willing to give you money for. Think about that for a moment. You have something that, as a business owner, that people are willing to give you money for it. And so that is a wonderful opportunity, right? It's a wonderful opportunity as a business owner, as an entrepreneur, to have an idea that you can execute and that you can take it to market, and people are going to say, wow, I really like this. And not only that, but then it becomes contagious and other people want it. Oh, excuse me. And before you know it, before you know it, you have become a household name, a staple in the brand, in the market. Okay, so that is a wonderful thing to think about, so that you can make that a reality for your business and for your future. So let's talk a little bit about, you're going to go through all of this evaluation and self-assessment, and you're going to look at your credit, and you're going to create this business plan, and you're going to work on this. The next thing you want to do is have a very strong pitch deck. Now, I have seen pitch decks that are like 5, 6 slides, others that are 8 to 10. This is 10 to 12. You don't have to do them all in like this. You can consolidate, maybe, put a few of them together. But this is generally speaking, it's a good deck. So a pitch deck is basically a way for you to be able to talk about your business in 10 to 12 minutes, okay? To an investor, to a lender, to a group of people who are listening to your idea that may become investors or may want to give you money for what you're going to do. And so that's what a pitch deck is. You're just putting together the answers that people want to hear or that they're expecting in regards to your business. Some of those questions are going to be, what is the pain point that your company is solving? How is what you have to sell going to address that pain point in the marketplace? They want to know, do you know the market size, the opportunity in the marketplace, the size trends, the segments of the market? What is your product? Do you have a demo? Do you have a prototype? Do you have a mock-up of it? What is your business model? In other words, how is it that you make money? What are the elements that need to be together, right, to create that synergy to make money? What are the strategies to going into market? In other words, how are you going to acquire customers? What are the milestones and traction in terms of number of users, sales, partnerships, etc.? Who is the team? Who are the people that are running this company and making, the world a better place? Who are the companies? Who are the members of this company that are the management, and who's actually doing the work? They also want to know your financials, projections, unit economics, break-even point. And then finally, how much are you raising and what is your ask? You're doing all of this presentation, this pitch, because you want to raise money, right? We started with that, evaluating your financial needs. That's how we started. And because you've done your business plan, you've done your financials, you've done all of this, now it's easy for you to say confidently, this is how much I need. Okay? And then obviously you close it with your vision statement or an impact statement, etc. And then of course, questions and answers. So this is sort of like, like you kind of follow this and you'll be all right. Okay, in terms of creating your pitch deck. And as I mentioned at the beginning of this webinar, I wanted to share some investors in the New York City region that you can reach out to. Hold on. Once you have a viable business, once you've done your homework, you have your business plan, your financial projection, your ratio calculations, all of that. Once you have your pitch, then you can, there's all of these investors. From angel investors or angel networks, you have Golden Seeds, New York Angels, and Pipeline Angels. From the venture capital side, you have Harlem Capital, Laurel Hypue, and AliCorp. And from the crowdfunding, you have iFund Women. You also have Republic, which is an equity crowdfunding firm. And there's many others. If you type, on Google or AI, what are the best crowdfunding platforms, you get a list, of those that are the most useful and where people see the best result. So I just wanted to share this with you so you at least have an idea of where to go next. Okay? Let's recap. You're going to assess your financial need. You're going to create a plan to access capital. You're going to assess your credit and your credit worthiness. You're going to look at the sources of financing and the sources of investors and determine whether you're going for an investor for your business or you're going for financing, a lender, a credit union, a bank, a CDFI. You're going to, after you've done all of that, create your pitch deck and practice that pitch deck so that when you go there, meet with the lender, meet with the investor, you sound like you know what you're talking about, okay? And you're going to do all of that to make sure that you sound credible, that you sound confident, that you sound like you know what you're doing, okay? And that's all for now. That's it for now. Any questions? Were there any questions on the chat?
No, the chat says thank you. It was very informative.
Okay, well, great. Well, then I will say goodbye. You guys have a great evening. A good July 4 weekend coming up, and a great rest of your summer. And thank you, Kenya and Jennifer and the rest of the team at EAC for this opportunity. Hopefully we'll see each other again soon. Have a good night.
Always